What's up there? In this lecture, we will understand what is SMT, its functions, and how to use it in a real market. So, without wasting a second, let's get into it. First of all, what is SMT divergence? SMT stands for Smart Money Technique. It is a cracking correlation or divergence between two correlated symmetrical markers. Now, these markers can be directly symmetrical or inversely symmetrical. What I mean by directly symmetrical, that there's a high for every high in both of these markets. But in the inverse markets, there's a high for low and low for high. It shows the interest of central banks and large hedge funds at a specific key level. And this is very important. SMT is not a model. It's the last step of analysis and confirming whether a trade is high probable or not. After you have done your analysis and you are at your high time frame key level, then you look for the SMT to confirm your trade idea and then proceed to other entry. SMT is the only confirmation that you will need as an ICT trader. That means SMT confirms every significant reversal point when it meets our analysis. Now let's understand SMT in bearish markets. If we have a high time frame key level, preferably bearish, where we are expecting the reversal toward the strong liquidity, in this case or low, this is sell side liquidity because we are in the bearish market. So if we have two markers that are closely correlated, in this case directly, which means there should be a high for every high and low for every low, and we are near the high time frame key level. So in these markets, the bearish SMT occurs when one asset makes a higher high, grabbing some liquidity, while a correlated asset fails to do so, and it creates a lower high. You see, this shows the potential weakness in this asset and interest of smart money within the ski level. The smart money are putting their orders in one of these markers, which is creating this divergence that we are interested in. Once again, the bearish SMT occurs when one asset makes the higher high, taking the liquidity, but another asset fails to take the high and create the lower high. That's what we call divergence between two correlated assets, which is SMT. This asset could be any of these, and this asset could be any of these. Now let's look at the SMT in bullish market. If we have a higher time frame key level where we are expecting a bullish reversal toward the strong liquidity, in this case all high, the buy side liquidity, and if our analysis suggests that we are going to go higher once price reach this key level, then we look into the markers that we are interested in and find the SMT. The bullish SMT occurs when one asset makes the lower low, grabbing the liquidity from the nearest low, and then another asset fails to do so, creating a higher low. So that's the divergence that we call SMT. After this SMT, we go on lower time frames if this is the higher time frame, or we take our entry right from this key level toward the strong liquidity. See, I want you to understand that SMT is not a model. You need your analysis to be well done and then a clear strong liquidity near high time frame key level. Then you look for the divergence between two correlated assets. These can be directly correlated or inversely correlated. After that, you look for the entry on lower time frames through this SMT. This SMT only confirms your trade idea that it is a high probable and you can take your entry. Now, this asset could be any of these, and this asset could be any of these. Now, let's proceed to SMT in opposite market or SMT in inverse market. If two pairs are inversely correlated, which means there's a high for each low in this market and low for each high in this markets. So if this asset goes up, this asset goes down. If this market creates a lower low, grabbing the sell side liquidity, and this market fails to create a higher high on the place of this lower low, then we call it SMT divergence. In these conditions, we can trade this one going short or this one going long. Same goes for this one. This is bearish SMT of inverse markers. You can see right here. If this one makes the higher high, confirming the strength, taking this partial liquidity, while this one creates the higher low, does not taking this lower low, then we said these are diverging from each other, creating this SMT, which shows the weakness in this pair and strength in this pair. We can go short in this one and long in this one. So that's how SMT works. But any of previous explained SMTs, whether it be bullish, bearish, or inverse SMT, works only when it is aligned with your higher time frame key level and your analysis. SMT is just the confirmation that helps you gain confidence in your entry, because this SMT shows the environment of smart money at the level where you are trading. So if this aligns with your higher time frame key level and analysis, you are good to go. Now that you understand what is SMT, let's move on to the live charts. This is USD JPY daily chart. I would like to add some analysis so that you understand what is going on. Right here, you can see we have taken this high, the price of liquidity, and then we hit this monthly bearish order block, taking these highs as well. So after it, price breaks down, and it does the market structure shift by breaking this low right here. You see these gaps and this aggressive move. There's the market structure shift. After this price comes back, gives us entry, and then it goes down to other higher time frame drawn liquidity. What I want you to focus on is this piece of price action right here. You see, we have this higher time frame strong daily bearish PPR. This is very strong PDA and high resistance. Price does not want to go higher than that, so it wicks right here, and then it goes to other strong liquidity. Now, based on this idea, we will go on lower time frame and look for the opportunities that is confirmed by the SMT. Here we are on forward chart. This is daily strong liquidity, previous day's lows, and higher time frame strong liquidity. You can see right here, price respect this daily bearish PPR. It's 50% level. Price is closing below it. Price is closing below it more than twice, and then it shoots lower. Let's zoom in a little bit more in this piece of price action. This is hourly chart, and if you focus, price is still respecting this key level, closing below it every time, and then it breaks the structure right here. Once it breaks the structure right here, we either go on lower time frame or we look for the opportunities on this chart and mark every period that supports the bearish prices. Right here, you can see this is bearish short block. This supports our idea of going short, and then this bearish inversion fair value gap with this fair value gap as well. Now let's look for the SMT that confirms that this third idea is really going to work and smart money are willing to trade this key level. So here we are. This is dollar index chart hourly, and this is USD JPY hourly chart. So to start off, we mark all the significant highs in the market that we are willing to trade. Right here, you see, I mark this high, and this high. We notice the time and we mark them on the correlated market as well. In this case, dollar index. You see? Now if you focus carefully, you will spot that this time where market creates this highest high and this time in this market are different. This is 9 p.m. candle and this is 12 p.m. candle. That's divergence, which we call SMT. Right here. This high to this high and this high to this high. So that's what we call SMT. In this case, the bearish SMT. It occurs when one asset, in this case dollar index, creates the highest high right here, taking these recent highs, while the USD JPY fails to take this high right here, showing the weakness of the price to go lower. And after this, we either go on lower time frame or take our entry right from these levels. Here we are back on our hourly chart. After we have confirmed the SMT, now we know that we can go short from these levels and trade toward the strong liquidity. But what we want to do is go on lower time frame and take our more precise entries there. We will also study this SMT on lower time frame as well. So let's move on to the 15-minute chart and see what we have there. You can see right here, we have this SMT and this SMT as well. If I add some analysis for this SMT right here, everything here will make a lot more sense. This is the daily bearish PPR and this is 15-minute bearish PPR. Price is respecting both of them with this wick and then it is going lower toward the strong liquidity right here, creating this failure swing. And if we are interested in this 1 hour SMT right here, which was from this high to this high, you can see that price gave us nice entry after creating this SMT with this fair value gap right here. We can go short from any of these levels and this one as well. This goes down toward the higher time frame key level. This was very amazing move. More than 200 pips in a single trade. Before I proceed on to the next example, I want to clarify that the moves that you see me getting 200 pips or 100 pips are based on these things right here in this chart. You see SMT, higher time frame key level and clear drawn liquidity. I combine all of these things with this lower time frame analysis and then I take the entries. That's how I catch these big moves in the market. Now you know it, and if you have guts, you're gonna practice it and you will see that this works every time when SMT is there. Now let's move on to the next example. This is Euro USD daily chart, the most recent price action. What I want you to focus on is this key level where price rejects right here. Why was it? Because of this, the monthly chart. You see, this is bullish monthly BPR inside this fair value gap. Price hits it and then it goes higher toward this high right here. After taking the sell side liquidity, of course. We have taken sell side and then we are going to the buy side. Right here. That's how it works. On the daily chart, it looks something like this. We have taken the sell side, this one, and then we go to the nearest strong liquidity, which is this. These failure swings, market structure shift, entries, and then boom. Now we're gonna go on lower time frame and look if SMT has confirmed this trade idea and gave us opportunities. Here we are on our forward chart. This one looks real beautiful. You can see right here, we have clear drawn liquidity, a higher time frame key level, and our analysis suggests that we are going to go higher. Then we look for the entries on lower time frame, which is this forward. Right here, market structure shift, entries in fair value gap, bullish order block, and then it goes boom. Once we have these fair value gaps and market structure shift, then we look for the SMT in the correlated asset. Right here, this is dollar index and this is the euro dollar. We have taken the buy side liquidity in this one, hitting this fair value gap on the monthly chart, and then we shift our structure, giving us nice entry right here inside this fair value gap. Same goes for this one. We have taken the sell side liquidity with this turtle soup, confirming our entry inside this higher time frame key level, and then price gives us entry right here. Now if you focus on these highs and lows near the higher time frame key level right here, after we have this fair value gaps, you're gonna spot a clear divergence between these two markers. I'll give you a second to look at it. Right here, you see this candle and this candle. There's divergence. If you want to argue that this is a small divergence, you can look at this one right here. Another divergence. A bullish SMT is when one asset makes the lower low or the higher high right here, and another asset fails to make the lower low right here. You see, this swing is not going lower toward these swings, but this goes higher toward this highs. That's the SMT. That's how SMT works. We look for the divergence between two correlated assets near the higher time frame key level after it aligns with our analysis. Our analysis, high time frame, key level, and draw on liquidity are very first step that we're gonna do. And then we jump to the SMT and confirm that our trade idea is correct. After that, we proceed to an entry and manage our risk accordingly. We are back on our forward chart right here, euro dollar. You can see after the SMT, we can take our entry right from this candle right here, take something off right here, or take our entry right here after this SMT, take something off right here. So what you understood in this lecture was that SMT is a divergence concept used in the ICT trading. It helps us identify when smart money are interested at a specific key level to manipulate the traders and then go to other on liquidity. This happens when two correlated markets, for instance euro dollar and pound dollar, act differently near the higher time frame key level when we have a clear drawn liquidity. So we go from higher time frame key level analysis and then SMT to the entry, and that creates the perfect trade idea for us as ICT traders. That's it for this video. I hope you learned something valuable, because this lecture could change your entire trading career. SMT is the key to high probable trade setups. Once you spot the SMT at higher time frame key level with clear drawn liquidity, that's when you're gonna enter in the trade without hesitation. If you just execute these trades with SMT, I believe that you will become profitable within months. That's not me bluffing about it. I have seen a lot of my students getting success with this one concept alone. That this one is really amazing concept. It can change your entire trading career. I want you to practice this one and get grip on this one. Now, see you in the next one. Till that, stay sharp, stay safe.